In this lecture, we'll cover the CFA Level I reading on discounted cash flow applications. The most important concept when we talk about discounted cash flow is the concept of net present value. The net present value is simply the sum of the present values of a series of cash flows. So for example, if you are working on a project and you have a cash flow that looks like this. At time 0 you spend 100, and then at time 1 you receive 25, at time 2 you receive 50, and then at time 3 you receive 75. So the NPV for this project is equal to the present value of minus 100 at time 0 is minus 100 because there is no time involved, plus the present value of 25 coming back to time 0 is 25 divided by 1.09. Why 1.09? Because the discount rate for this problem is given as 9%. The next payment that you receive is 50 from here, and notice that this is at the end of year 2, so this needs to be discounted back 2 periods. So we have 1.09 squared, so this becomes the present value of 50 which you get after 2 years, and finally you receive $75 after 3 years, so the present value of that becomes 1.09. So 75 divided by 1.09 cube. So you add all this up and you will get 22.93, and this is the net present value of the given cash flow. What does net present value tell you? It tells you that essentially the present value of these future cash flows is more than the cost that you incurred of minus 100. And we use the term net present value because you are netting out the initial cost of minus 100. Notice the minus 100 in this calculation. So the present value of the future cash flows is 22.93 more than the initial cash flow of minus 100. And what this suggests is that this project should be done because it is making you better off. Okay, the calculations that we just did can be quite long-winded. So what we are going to look at now is the use of the calculator for these calculations. The way you do this on your Texas Instruments calculator is as follows. Let's say we have the same cash flows, and the first thing you do, you to use the cash flow button. So you click on cash flow and then you click second and clear work, and just to be safe also click second and clear time value of money. So now you have cleared all your cash flow registers. Then you will see an entry for cash flow 0. So you set that cash flow 0 equal to 100. So enter 100 and then plus minus that you get from here. This ensures that the value of cash flow 0 is minus 100. Then you click the down arrow. So you click the down arrow and then the next entry would be cash flow 01, which you specify as 25. So you put in 25 and then hit enter, which is this button over here. Actually, even after the minus, after putting in 100 plus minus to make it minus 100, you should put enter after that, which is this button. And you keep going. Actually, after cash flow 01, you will notice a frequency 01. This will be set as default to 1, which is simply saying that cash flow of 25 happens once, so you just accept that and press down arrow. Then the next thing you do is cash flow 02, so this is your second cash flow. Set that as 50 and then hit enter, down arrow, and again you will see if the frequency of this will be 1, so you accept that, and down arrow again. So then put in cash flow 03 is equal to 75, enter, and make sure again that the frequency for that is 1. So what you have now done is you have essentially told the calculator that you have given this data to the calculator. So you said at times 0 the cash flow is minus 100, and then for times 1, 2 and 3 you have essentially given the calculator this data. What you haven't told the calculator yet is the discount rate of 9%. So the way you do that is, after having entered the cash flow, you click you press on the NPV button, which is right here, and you will notice that when you press the NPV button, you will see I equal to 0. What you do there is put in 9 for the interest rate and hit enter, and then you hit the down arrow, which is this one again, and after that you hit compute, which is top left, and this will give you the NPV. If you've entered these numbers, so you will now get the NPV equal to 22.93. So practice this a few times. You should become really good at using the calculator. Okay, so what's the interpretation of NPV and what are the important NPV rules? The most important rule is that you accept projects with a positive NPV. Positive NPV projects will increase shareholder wealth. Effectively, what this means is that the present value of your future cash flows, so the present value of future cash flow is greater than your initial cost given the discount rate, and this will mean that your NPV is positive. When NPV is positive, you accept a project. Reject projects with a negative NPV. Negative NPV projects decrease shareholder wealth. When two projects are mutually exclusive, which means that only one can be accepted, the project with higher positive NPV should be accepted. If NPV is 0, the project adds no monetary value. Decision should be based on other criteria, example strategic positioning or other factors not explicitly included in the calculation. So this is a side point. Now let's talk about another very important concept, which is the internal rate of return, or IRR. IRR is the discount rate that equates the present value of a series of cash flows to their cost. The IRR is the discount rate that makes the NPV equal to 0. Let us just do a calculation for IRR and then we will talk about its interpretation. So notice that IRR is the discount rate that makes the NPV equal to 0. So here is the same cash flow that you are now used to. What is the IRR? Remember, IRR is the discount rate that makes NPV equal to 0. Let's say that the IRR is X. Now what is the NPV? The NPV for this would be minus 100 plus 25 over 1 plus X plus 50 over 1 plus X squared plus 75 over 1 plus X cube. So this is the NPV. Now as you see above, what is the value of X that makes NPV equal to 0? This is one equation, one unknown. It can be solved, though obviously solving this can be a little tedious. You can do this by trial and error, or you can do this on your spreadsheet. But if you spend enough time, you will notice that x is equal to 0.194, which is 19.4%. So this is the IRR for the project. The interpretation is that this project, given these cash flows where you invest 100 and then get 25 after 1 year, 50 after 2 years, and 75 after 3 years, you are getting a return approximately of 19.4 on this project. It's a useful thing to know. So you can tell now that the approximate return is just under 20%, which is good. Now let's try to solve the same problem using a calculator. And the way you do this is, again, you first, as we did before, you get into the cash flow mode by clicking on the cash flow button, then clear everything. So do second clear work, and not completely necessary, but just to be on the safe side, press second and clear TVM, which is right there. So all the registers are clear. Then, like you did with the NPV problem, you plug in cash flow 0 as minus 100, and then down arrow, so enter, never forget the enter. So down arrow, then cash flow 1 is equal to 25, then down arrow twice because you are passing past the frequency. Cash flow 2 is 50, again enter cash flow 2, and then down arrow twice over here. Cash flow 3 is equal to 75, enter. So you've entered all the cash flows, and then you press the IRR button, which is right here, and then you press the compute button, and this will give you IRR equal to 19.4, much faster than the manual process we used earlier. And again, practice this a few times and make sure you are comfortable with using the calculator to come up with IRR. What is the IRR rule? Do a project or accept a project if IRR is greater than the rate of return that could be earned by alternative investments of equal risk. So for example, if on another project of equal risk you can get 9%, but on the project that you just calculated, you are getting 19.4%. Since 19.4% is greater than 9%, then you should do the project. And you should reject projects with an IRR that is less than the firm's required rate of return. So if the firm's rate of return is 9% and you come up with IRR equal to 8%, you should reject because 8% is less than the 9% required rate of return. I'll describe this briefly right now, but we'll see it in more detail in corporate finance. But this comparison number, you will see it described in different ways. Sometimes it might be described as the rate of return that could be earned by alternative investments of equal risk. Sometimes you will see this as a required rate of return. Sometimes you will see the concept of cost of capital. So these three, so required rate of return, cost of capital, or the rate of return that could be earned by alternative investments of equal risk, I'll label this 3. 3 of these are the number that you compare your IRR with. And as long as your IRR is greater than this benchmark or reference number, then you accept the project. If not, then you reject the project. What's the intuition behind this? The intuition is that your required rate of return is 9%. This might be the return that you get by putting your money in a bank or putting your money in another project that has the exact same level of risk. So if you can get 9% there, and you can, let's say, get 12% on the project that you are evaluating, clearly you should accept the project because you are making more money or getting a higher return by investing in the project. On the other hand, if you are getting a return of 7%, then you should reject the project because the 7% return is less than your return on the return of 9%, which we said is your either required rate of return or the return that you can get on another project with similar risk. Okay, so let's work on a small example. So a corporation must decide whether to introduce a new product line. The startup cost for this project is 100. So at time 0, the cost is minus 100,000. And what will happen after this? After that, year 1, year 2, you are going to have outflows of 5,000 per year and cash inflows of 17,000. So net effect is we are going to have cash inflow of 12,000 forever. So notice that this is a perpetuity. Okay. Also notice that you are given the opportunity cost of capital as 10%. So that's the rate that you use over here. What is should the new product line be introduced? Let's say that we use the NPV formula. Remember, if NPV is greater than 0, then you accept. So let's calculate the NPV. NPV is equal to minus 100,000 plus the present value of this perpetuity. If you recall the formula for a perpetuity, the formula is the formula for the perpetuity, present value for perpetuity was A over R. What is A? It is 12,000 divided by what is R, or the discount rate. Discount rate here is 0.1. So we essentially have minus 10,000 plus 120,000, which is 20,000. So notice that the NPV is positive, therefore you accept the project. How will you calculate the IRR for this project? The way you can calculate the IRR is figure out the discount rate at which NPV is 0. So let's say minus 100,000. So now we are doing IRR calculation. So minus 100,000 plus 12,000 divided by the IRR, set that equal to 0. And when you come up with IRR over here, so solve for IRR, you will notice that you will get IRR approximately equal to 12. So approximately equal to 12, which is greater than 10, and therefore you accept this project. What are possible problems with the internal rate of return method? We'll see this again in more detail in corporate finance, but just to give you a brief sense right now, when a series of cash flows goes from negative, so if you have negative 100 and then plus 10, plus 20, and then say minus 50, and then again plus 100. So it's going from negative to positive to negative to positive. So there is more than one sign change. If there is more than one sign change, then it is possible that there is more than one IRR. On your calculator, you are going to get an error when you try to calculate the IRR. So this is one possible issue. Another possible issue is that if you are trying to rank projects, so let's say A, B, just rank 2 projects, it's possible that NPV of A is greater than the NPV of B, but the IRR of B is greater than the NPV of A. So this is possible, and that creates a conflict. Whenever there is a conflict, you always go with the NPV method. So NPV always trumps IRR if there is a conflict. But as I said, there is a lot more detail on this in corporate finance, so we will worry about this later. Okay, the concept now of holding period return, or HPR. Almost every return that you will see in general is a annualized return. So if you say that if you see somebody giving you a return of 12%, that would be an annualized number. The exception to this is when you are told that you are dealing with a holding period return. Holding period return is by definition over a given period. So if we look at this example, investment purchased 9 months ago for $9 is now valued at 10.2. So what's the holding period? The holding period is 9 months, and the return going from 9 to 10.2 is 13.33%. So we can say that the 9-month holding period return is 13.33%. Another example, you purchased a stock 1 year ago for 29, which just paid a dividend of 1.3 and is valued at 30.5. So on an investment of 29, you essentially made 30.5 plus 1.3. So your holding period return is 9.66%, and the holding period was equal to 1 year. How do you do this? What is the holding period for a stock that is currently selling for 60 per share if it was purchased exactly 1 year ago for 50 and paid a $2 dividend? The way you do this is your investment was 50. On the investment of 50, at the end of the year, you made 60 plus 2. So essentially you made $12 on a $50 investment. So this gives you a return of 24%. So this is your holding period return over 1 year, because the problem tells you that this happened over 1 year. So now let's say you are a portfolio manager. Clients give you money and you invest that money. You buy stocks, bonds, etc. And every quarter you need to give you need to measure your performance. So how do we measure what sort of a return you are giving your clients? There are two ways of coming up with that return metric. One is called a money weighted return and the other is time weighted return. A money weighted return simply applies the IRR concept which you just studied, and we will apply this to an example on the next slide. The money weighted return calculation depends on the magnitude and timing of cash inflows outflows. So cash inflows outflows refers to the money that you receive from your clients or the money that clients might take out of your fund. We'll see how this works on the next slide. A second way of coming up with the performance metric is called the time weighted return, and this applies the concept that let's say that you've had money for a 3-year period, and the question is for let's say the $100 invested at the start, what is the annualized return that you have given over 3 years? So it does not depend on any cash inflows outflows during the year. It depends simply on the investment decisions that you as a fund manager have made. So this is an annualized number. And after doing money weighted return, we'll do an example of time weighted return. This time weighted return, as I mentioned, is not impacted by the magnitude and timing of any withdrawals or any withdrawals your clients might make or any additional funds that they might put into your fund. Time weighted return is therefore a better manager if you, the fund manager, do not have control on the timing of cash inflows and outflows. On the other hand, if you do have control on inflows and outflows, then money weighted return would be a better measure. So let's look at how we calculate the money weighted return. And as I said earlier, this basically applies the IRR concept. So take this example. Let's take a 2-year investment horizon. So let's draw our timeline. At time 0, you take $200 to purchase the first share. Negative sign because this is a purchase. And then after 1 year, you purchase a second share. So this is the same stock. So let's say you are talking about XYZ company stock. You bought that at time 0 for 200. After 1 year, that share became 225, and you decided to invest in another share. So you paid $225 for it. Those were your outlays. In terms of proceeds, after 1 year, you got a $5 dividend on this share that you had bought at the start of year 1. And after 2 years, what do? You receive a $10 dividend on the 2 shares. So $5 per share. At this stage, remember, after buying the second share, you now have 2 shares. You get a $5 dividend for holding the 2 shares for the year, and that gives you plus 10. And then after receiving the dividend, you sell both shares for $235 each. So you make a total sum of $470 by selling the 2 shares. So what's your overall proceeds for the 3 years? At the beginning, you just invested 200. After 1 year, you invested 200 but got a 225 but got a dividend of 5. So your net amount is 220, and at the end of year 2, you receive 480. So you plug this into your calculator. You have cash flow 0 is equal to minus 200, cash flow 1 is equal to minus 220, and cash flow 2 is equal to 480. And when you compute your IRR, you will get IRR is 9.39%. So very straightforward. Just plug in your cash flows and use the IRR to get your return. Now notice that, and try this yourself. If the stock price had been different, or if, let's say, rather than simply buying 1 share, you had bought 20 shares. So if the magnitude of the investment is different, that will have an impact on the IRR. So if your clients give you a ton of money here, that will impact this IRR number. And even though your investment decision was to buy the stock at time 0 and then buy that same share again at time 1, but the fact that the amount of investment the client is going to make will have an impact on IRR. So that's an important constraint to keep in mind when you are dealing with money weighted returns. Now let's take an example of that allows us to calculate time weighted return. So here, the way we calculate time weighted return, we look at the return for every period. So 0, 1, 2. You look at all the major points where there are either inflows or outflows. So there is a major inflow at time 0 where you purchase shares for 200, and then after 1 year the share is worth 225, plus there is a $5 dividend. So you need to identify these points where there are major cash inflows, outflows. Here the situation is simple because the inflows, outflows are happening at the beginning and end of every year. On the next slide, we look at what happens when inflows happen during the year. So here you went from a $200 investment. On the $200 investment, essentially you have $230 at the end of the year, $225 in the form of the share, and $5 in terms of the dividend that you got on this share. So from 200 to 230, basically you made a 15% return in year 1. So that's done for year 1. Now what was your return in year 2? In year 2, You again purchased a share for 225. So let's just do that here. You purchased a share for 225, and how much did that share become at the end of the year? At the end of the year, that share was worth 235, plus you got your $5 dividend. So what's the return over here? You went from 225 to 240. So this gives you a certain return, which is equal to, so this is equal to 6.67%. The other way of looking at this would have been that you actually had two shares over here. So two shares collectively were worth how much? They were worth 450, and 450, when you sold the two shares, you got 470, plus you got a dividend of 10. If you go from 450 to 480, this will also show you a return of 6.67%. Basic point is, we take all the major points where there are inflows or outflows. For this first year, the return was 15%. For the second year, the return was 6.67%. And now, how do you annualize your return? Your time-weighted return is going to be the geometric mean of these two returns. So in the first year, you have 1.15. So 15% means that your $1 became, at the start of year one, became 1.15. So multiplied by, over here you grew at 6.67%. So you do times 1.0667. So this is simply saying that your $1 here grew at 6.67%. And since it's 2 years, you raise it to the power of 1 over 2. The 2 represents the number of years. And when you come up with this number, you will have 10.76%. So this is your time-weighted return. Now, what we've done there is a really simple example. What if during the year, so during year one, so this is year one, let's say that during this year there are multiple cash inflows and outflows. So let's say that you have a situation where $100 were invested at the beginning of the year, and halfway through the year, let's say that another $100 are invested. So initially you put in 100, and actually after half a year you put in another 100. Now the way you figure out the return for the year, you look at the return from this period to this period. Let's say that based on the investment made, the return over here was 20%. And let's say that the return in the second part of the year on money that you had over here was 30%. So if the return was first 20%, then 30%, the overall return for the year will simply be 1.2 multiplied by 1.3. So if you do 1.2 times 1.3, you get 1.56. So over the year, we have a 56% return. So that's what you do when you have multiple returns. How do you deal with negative numbers? So if you first have, so you invest some money here, and in the first 6 months you get a 20% return, but in the next 6 months you lose 10%. So your return for the year would then be 1.2 multiplied by 0.9. Losing 10% meant that your $1 becomes 0.9. So for minus 10%, you put in a 0.9. So your return for the year will be 1.2 times 0.9, which is 1.08. So overall during the year we have a 8% return. So that's our time weighted return.